Paradice was founded in 1999 by David Paradice, and it started life as a small cap fund, and since then it's flourished to become to have two different products in Australia, including our product, which is the mid cap product, and we also have a global product based out of Denver. In terms of the firm itself, it's actually fully owned by staff, which we think is important. And if you look at the hallmarks of Paradice, like a few things that we think were important. Number one, there's a pure focus on investing. Secondly, as investment staff, we think it's important that we're both humble plus objective. And finally, we feel it's important that we put structures in place that fully align our interests with that of our unit holders. We feel that equity markets are inefficient, and at times we see that they're driven by both greed and fear. So to give an example of greed, late 99, early 2000, the tech boom, we saw companies driven to ridiculously unrealistic valuations. Likewise, 2007, before the financial crisis, we saw a lot of companies running ahead of their fundamentals. Likewise, we see fear. So post both of those, we saw huge crashes in the market. In fact, after 2007, the GFC stocks fell by almost half of their value. So these provide real opportunities for us. And in terms of the way we look at things, we basically just try and focus on fundamentals, filter out the noise, and then look for mispricing. And we then try and take advantage of those opportunities.
The actual mid-cap index encapsulates the stocks from effectively number 51 to number 100 from a market capitalization point of view. The Paradice Mid-Cap Fund looks at a slightly broader universe. We look at all the stocks outside the ASX top 50, all the way down to a market capitalization of $400 million. And we benchmark ourselves against a composite index, which is weighted 70% mid-caps, 30% small caps, as that universe runs across both mid-caps and small caps. So what that means for us as investors is that we look at approximately 230 stocks that's got a combined market capitalization of north of $300 billion. And Matt and my job is to trawl through those companies and look for the best 50 to 60 ideas out of those 230 stocks.
Well, the objective of the fund is to outperform our index by 3% per annum, which is something, fortunately, that we've managed to exceed over the longer term. But it's not just that, it's actually to provide those superior returns on a risk-adjusted basis with one eye to capital preservation. And in that regard, it's important, if you look at, since our fund started back in 2006, in the months where the index has actually been negative, so it's underperformed, we've actually outperformed the index 85% of those times. So it does show that we do have that capital preservation in mind.
Matt mentioned how the market is inefficient and how we actually capitalize on this to make our investment decisions. A lot of that feeds into our philosophical approach about our investing. End of the day, it's really important that we look at all the potential investments from a bottom-up perspective. As a group at Paradice Investments, we don't have any travel restrictions. We really believe is in actually getting out into the market, getting as much information in as possible. We do run all of our own models, but models are only good as what you input into them. And we've got a couple of favorite little sayings at Paradice, and one of them is, denial's not a river in Egypt. And the other one is, hope is not a strategy. And they are common, well-known sayings, but they are so true when it comes to, investing in the stock market. And another one of the little gems I think about Paradice is that the environment and culture in which we work is very conducive to an open sharing of ideas. We're very quick to recognize our mistakes, and I think that is so important, especially in markets where there can be a lot of volatility at times. And from a management point of view, you've got to have regard for the management that are actually giving up their time to actually sit down with you, for the other corporates, for the other industry bodies that are spending time with you. So we actually at pains before our meetings, we spend a lot of time preparing for those meetings. You have to respect the people that you're meeting with. And that way we feel that we can actually get out there, bring as much information into the company as possible, and we can put that information into our thinking about stocks and how we invest and how the stocks fit into our portfolio.
In terms of identifying investment opportunities, there's around 220 different stocks in our sector. Now, we've both actually been in this end of the market for over 20 years, so it sounds like a lot of companies, but we are actually familiar with all of those companies. And we're constantly keeping an eye on those companies, watching those companies, seeing them at results time, crunching the numbers on those companies. And from what we see getting out there and from all of the travel that we do seeing these companies, we then limit that, we then refine that down to a certain number of stocks where we think the best opportunities might arise. And then we do further investigation on those companies. We'll go out and see them, do additional work in terms of valuation and models, and based on that we then choose the companies that sit in the portfolio.
The stocks that we invest in generally have a very strong growth profile. You've got to be really conscious of the fact that even great companies with great growth profiles, they do hit potholes along the way and they do tend to get overbought. So it's really important for us to be fairly flexible in our thinking. You don't want to get too attached to specific sectors. You don't want to get too attached to specific stocks. And as I mentioned early on, you have to be quick to actually react to your mistakes. If you find that you concentrate too much of the portfolio in specific areas, in specific stocks, specific sectors, and you don't have that flexibility in your thinking, we certainly believe that that's possibly the biggest risk that you can actually put into your portfolio.
Well, if you look at most Australian mid-caps, they actually tended to start life as small cap companies, and then they proved very, very successful at what they did, and they went on and moved into our space. And what we find is that when they do move up into our space, that success really continues. So if you look at the breakup of the Australian mid-cap index, what you tend to find is there's some very unique and, in fact, in many cases, world-leading companies in a variety of industries. So if you look recently in terms of some of the companies that have been in our index, you've got everything from the leading cochlear implant company in the world, one of the leading wine companies in the world, leading gaming machine company in the world. So there's a huge variety of very, very good companies in there. What we also tend to find is that from a market perspective, it's actually a space that tends to fall a bit between the gaps. It's not particularly well covered. There's not a lot of genuine competitors in our space. And whenever that happens, that really provides opportunities. So we get an opportunity to look at these companies that not as many people are looking at and to take advantage of that and buy those companies in many cases at good prices.
Ideally, money should be left in a portfolio, in a fund for as long as possible. Just by way of example, Matt and I set up the mid-cap fund in September 2006. The GFC hit us barely a year after that. But nonetheless, if you look at where the fund is today, we are well ahead of where we were when we started out. And I think that just highlights the fact that you can never pick the tops, you can never pick the bottoms exactly, and time is always your friend when it comes to investing.